Good afternoon, everyone. Today we will look at end of year adjustments, and also we will look at statement of change in equity. So let's do a little bit revision. So for the last 2 weeks or last 3 weeks, what we've done, we have introduced the financial statements, and we have done 2 financial statements, including statement of profit or loss and statement of financial position. And remember, statement of profit or loss, it does measure the profitability of the business, and a statement of financial position is based on the accounting equation, assets minus liabilities equal equity. Today we will look at end of year adjustments, and we will start with depreciation. Right, before we start the topic here, depreciation, so what I want you, if you can, click on this link and watch this video. After watching this video, right, so tell me, what do you think, what happened after the Mr. Bean's car crash? So what happens in the car? What is the value of the car? So the value of Mr. Bean's car dropped after the accident. So this same exactly when it comes to the business, right? When it comes to the business. So now think about it. When I talk about the non-current assets in the business, non-current assets including equipment, laptops, computers, including cars, vehicles, trucks, all of these are what are non-current assets. And these non-current assets, they are being used every year, isn't it? For example, let's delivery a vehicle, okay? If you order from a restaurant or from a Pizza Hut, you will have a delivery vehicle, Pizza Hut delivery vehicle. They are being using this car every year, isn't it? Right? Of course, the value of this car, is dropping every year. Yes, they bought it £10,000 and they recorded under non-current assets vehicles £10,000. But after 1 year, do you think the value would still £10,000? Of course not. Of course not. So the value of non-current assets, or the value of this car, is dropping over the years. Why is dropping? Because it's being used. And that what comes to depreciation. So depreciation, it's a method, it's a way to spread the cost of the fixed assets or non-current asset over its useful life. Of course, this is a method that you need to include it in a statement of financial position. So where you're gonna record the cost minus depreciation or accumulated depreciation in order to find the value, the market value of the non-current assets. Let's have a look at these important things or factors. 4 factors you need to consider when you calculate depreciation. Okay, let me give you an example, right? If you have a laptop right now, you bought a laptop, £1,000. This is your laptop, you bought it today, £1,000. Okay, this laptop, you think that after 5 years, you said after 5 years you will sell this laptop for £300. So first of all, the cost would be £1,000. The first factor, the cost of the assets, is £1,000. The useful life is 5 years. The useful life is what? Is 5 years. This is the useful, the period of time you think you're gonna have it, which is 5 years. After 5 years, you believe or you expect that you will sell a deposit of £300. This is the residual value or disposal value, residual value. Okay, and the last factor, the depreciation method. We have two types of depreciation methods. We have the reducing balance method and we have straight line method, and we will explain these two methods in a bit. Okay, so again, that explain what we've just what we've just done right now. The cost of the assets is how much you pay for the assets or the business, the useful life, residual value. Of course, that's based on estimation, remember. And the depreciation method, as I mentioned, we have two types of depreciation methods. We have a straight line method and we have reducing balance method. So the first method we will start with is a straight line method. Straight line method looks a bit easier than the reducing balance method. Let's have a look. The cost of this furniture is £78,124. That's what we bought or the business bought. The estimated useful life, they think that the furniture will last 4 years, and after 4 years they will rid of it and they will sell it for £2,000. This is the residual value, If I ask you to calculate the depreciation, the yearly depreciation, the annual depreciation, the formula for this, write it down. Cost minus residual value, cost minus residual value divided by useful life. And if you look here, right, you will see that the cost 78124 minus the residual value 2000 divided by useful life 4 years. So the annual depreciation is 19,031. Can you see, guys, here? Yeah, 19,031 pound. What does that mean? This means that the business, the value of furniture will drop every year by 19,031 pound. Right? How can you record depreciation and furniture in the financial statements? So have a look. Right. First of all, you need to understand that depreciation is an expense. Depreciation is an expense to the business. Remember this. And should be recorded under the expenses section in the statement of a profit or loss. If you look here at this question, under straight line method, the annual depreciation of 19,031 pound is fixed over the 4 years. So every year is 19,031 pound. And as you see, for instance, in last year, in 30th of September 2019, when we include the expenses, we bought depreciation 19,031 pound. The next year, again, we write depreciation 19,031 pound in 2020. And in 2021, again, we will write depreciation 19,031 pound. And in 2022, again, we will write depreciation 19,031 pound. Can you see? For 4 years, you're gonna include it. But in September 2023, you will not gonna write anything. Why? Because 4 years. It's been 4 years, and you should stop writing the depreciation. This is how to treat depreciation in a statement of profit or loss. But now how to treat the non-current assets, the furniture under the statement of financial position under non-current assets or fixed assets. So what you need to do, you need to reflect the fair value. You need to reflect the fair value, the current value, the market value, right? So if you look here, the first in 2019, we agree that the cost of furniture £78,124, but at the end of 2019 is being depreciated for 1931. So the value dropped by 19,031 in the first year, and that's why you take it away. You deduct it. So 78,124 minus 19,031 equal 59,093 pound, and this is the net book value. MBV stands for net book value, right? Again, when it comes to 2020, what you need to do, you need to follow the formula, which is the cost minus accumulated depreciation. When I say accumulated depreciation, it means that the depreciation for this year plus the depreciation for previous years. So the depreciation for 2020 is 19,031 plus the depreciation for the last year's 19,031. So if you add them together, it formed accumulated depreciation. So cost minus accumulated depreciation equal the net book value. And in 2021, so what you need to do, the accumulated depreciation will be 1931 plus 1931 plus 1931. And in September 2022, you will have the 1931 4 times. The 19 time will be 4 times there. And this is the way how can you calculate depreciation and net book value. So remember, after 2022 or at the end of 2022, the net book value must equal £2,000, which is equal the residual value. Look, the residual value is £2,000. So after 2022, so the net book value must equal £2,000. The value. Will be the value of the furniture. Okay. Now, if you look at this chart, what you can see here, you can see that the depreciation, right? The depreciation is the depreciation using straight line method. As you see, what happened? The depreciation is fixed every year. It's fixed, yeah, £19,031. In terms of net book value, and again, it does reduce the amount by the same, the equal amount, which is 19,031 every year. Can you see? Yeah. So we start the value of 79,000 something, and it dropped 19,031 every year. So at the end of year 4, so the value should equal £2,000, which is equal to residual value. Okay, great. Now let's go to this example or exercise. Let's practice on this exercise, and hopefully you will get it. Okay, so try it on your own and then come back and see the answers. Swansea falafel shop. So I hope you like falafel. Have you ever tried falafel? It's really nice, healthy, vegetarian, lovely, beautiful. Swansea falafel shop has purchased a small car for deliveries for £16,000. So this is the cost, is £16,000. And it's estimated that it will be used for 3 years. So the useful life is 3 years. And after 3 years, they will sell it for almost around £5,500. So this is the residual value at the end of year 3, of course. So the question asks you to calculate the net book value at the end of year 3 using the straight line method. So let's apply the formula, which is the cost minus residual value divided by useful life. So 16,000 minus 5,500 divided by useful life, which is 3 years, that comes with £3,500 per year. So the depreciation, the annual depreciation, is £3,500 per year, and you recorded, if you remember, you need to record it in a statement of profit and loss under the expenses for 3 years. For 3 years, you record the same amount, £3,500. We have no issues with this, yeah? I hope so. So now, when it comes to net book value, you need to calculate net book value each year. So let's start with year 1. With year 1, okay, and of course remember that you need to record it in a statement of financial position under non-current assets. Remember this. So cost minus accumulated depreciation. Let's start with the first one. End of year 1, the cost minus the accumulated depreciation, which is only 1 year. This is the first year, 3,500. So net book value is 12,500. This is end of year 1. Now, end of year 2, yeah, end of year 2, as you see, cost minus accumulated depreciation, 7,000 the accumulated depreciation. Why? Because accumulated depreciation is the depreciation for this year, which is 3,500, plus the previous years, which is 3,500. So that comes with net book value, £9,000. So at the end of year 3, again, the cost 16,000 minus again the accumulated depreciation, which is 3,500, 3,500, 3,500. So that comes with 5,500. So again, as you see, the net book value at the end of year 3 is equal what, guys? Equal the residual value. Equal the residual value. Okay? Clear, guys? Yep. Straightforward, isn't it? Nice. So now let's jump to the second method. This method is a bit not really straightforward like straight line method, but still manageable in a way, isn't it? Right. Reducing balance method. Reducing balance method. Reducing balance method allocate a fixed percentage rate. We allocate a fixed percentage rate of depreciation to the net book value of the assets each year. So here we rely on what? We rely on a percentage. We rely on a percentage. If we use the same exercise, if you remember the first one about the furniture, did you remember the furniture? The £78,124, do you remember? Yeah, for 4 years. So we do the same example exercise, but the only extra information here that tells you that 60% depreciation charge. So the question, it does tell you that there is 60% depreciation charge. Okay. So now how can you calculate depreciation and net book value using reducing balance method? Right, let's have a look. First of all, when you start with year 1, let's start with cost of the furniture you multiply by depreciation rate. So the cost, which is £78,124, as you see, you multiply by 60%, and that comes with 46,874. And this is the depreciation for year 1. This is the depreciation for year 1. So the cost, which is 78,124 minus 46,874. It comes to 31,250, and this is the net book value at the end of year one. Net book value at the end of year one. When it comes to year two, what you need to do now, you need to multiply the 60% not with the cost, you multiply by the net book value at the end of year one, which is the 31,250. You multiply by 60%, and the annual or the depreciation in year two would be 18,750. 18,750. Now, in order to calculate net book value at the end of year two, again, what you need to do, the net book value at the end of year one, which is 31,250, you minus the depreciation in year two, which is 18,750, and that will give you 12,500 pounds. 12,500 pounds. Again, when it comes to year three, what you need to do, the 60%, you need to multiply by what? By the net book value at the end of year two, which is the 12,500 times 60% equals 7,500. So 7,500 is the depreciation in year three. If you calculate the net book value in year three, so net book value in year two, 12,500 minus 7,500 is the depreciation in year three. It comes to net book value at the end of year three, which is 5,000 pounds. And the last year, the 5,000 pound, the 5,000 pound you multiply by 60% is a 3,000 pound is the depreciation in year three. Yeah, and in order to calculate the net book value in year four or the end of year four, what you need to do, the net book value at the end of year three, which is the 5,000, you minus the 3,000 and equal 2,000, the net book value at the end of year four. And as you see, it's 2,000, which is equal to residual value. Right, now how can you record it? How are you going to record it in a statement of a profit or loss and a statement of financial position? We did explain it. You need to record depreciation in a statement of a profit or loss under the expenses section. But here, what's the difference here? The difference that the depreciation, the yearly depreciation is different from year to year. Right? Can you see? For example, here in 2019, 46,000, right? So here, look, the figures we came from here anyway. 46,874. In year 2, second in 2020, 18,750 the depreciation. In 2021, 7,500. And in 2022, 3,000 depreciation. Can you see? It's not similar to what? To straight line method. If you remember the straight line method, yeah, the straight line method, it was the fixed annual depreciation every year, fixed every year. But here they are changeable. Okay. In terms of net book value, again, you need to record in a statement of financial position under non-current assets, fixed assets, and you need to apply the formula which I ask you to do it, which is cost minus accumulated depreciation. So in 2019, you take away the depreciation for year one. In 2020, you took a depreciation for 2020 plus 2019. Can you see? In 2021, you take the depreciation 2021 plus 20 plus 19, and it's the same. Yeah. So as you see, anyway, we calculated net book value here. As you see here, the net book value in year 1, 31,250. In year 2, 12,500, which is 2020. 2021 is 5,000, and in 2022 is 2000. Okay, guys. So this is again, this is a statement of financial position and how to record the net book value or the furniture. If you look at this chart, yeah, if you look at this chart here, and this does reflect the net book value using reducing balance method. If you look at this chart, yeah, and you go back and you look at the straight line method chart, so think, what is the main difference here? The main difference that in reducing balance method, as you see, in year one, the highest depreciation will be in the early years, which is year one. Can you see in year one, the highest, isn't it? In year two, higher. And when it comes to year 3 and 4 is the lowest. Can you see? So reducing balance method, as you see here, so the depreciation in year 1 46, in year 2 18, in year 3 7,500, and year 3 3,000. So can you see? So this is reducing balance method, charge depreciation higher in the early years. Opposite of what? Opposite of straight line method, which is annual depreciation each year. So now a question you need to ask yourself, or ask me maybe, why do we have two methods? Why they are different? So there are two different methods, but the business is up to the business to use which method really. So some businesses they use a straight line, some businesses they use reducing balance. So it's up to them really what they want. However, they need to make sure as a business that they follow the accounting regulations in terms of, for instance, if they want to use, they should use all the non-current assets using one method. Not, for example, I want to use computer using reducing balance, or maybe I want to use furniture using straight line. So it has to be a bit of consistency there. Okay. So now let's have a look at exercise 2. If you remember this exercise 2 regarding the delivery vehicle for this shop, and we bought this vehicle for £16,000, and for 3 years the useful life, and 5,500. It's what? It's the residual value. It's the residual value. And the question, if you look at the question asks you to calculate the net book value at the end of year 3 using a reducing balance method at a rate of 30% per annum. So now the question told you that there is a 30% per annum, and this 30% you need to start and multiplying by the cost, which is £16,000 in year 1. Let's do it. Or actually, you do it first and then come back and see the answers. Okay, let's have a look. In year 1, you start with the cost 16,000, you multiply by the percentage 30% equal 4,800. So 4,800 is the depreciation in year 1. Depreciation in year 1 is £4,800. So the value or the net book value at the end of year 1 is what? Is the cost 16,000 minus the depreciation in year 1 £4,800. So that's £11,200. End of year, or actually start with year 2. Year 2, what you need to do, you multiply 30% of what? Of 11,200, which is the net book value at the end of year 1. So 11,200 times 30% equal 3,360. It's the depreciation in year 2. The depreciation in year 2. So when you calculate the net book value at the end of year 2, what you need to do, you just take away, yeah? So 11,200 minus 3,360. 2,360. That's 7,840. So add the depreciation in year 3, 7,840 times 30% equal 2,352 is the depreciation in year 3. So in order to calculate the net book value at the end of year 3, very simple, the net book value at the end of year 2 minus the depreciation in year 3, then you will find out the net book value of year 3 is 5,488. So which is equal to residual value. So as you see, the residual value is 5,500. So there is a 12 pound difference. This is due to decimals. So don't worry about it. You just ignore it. Again, you might find it a bit challenging with reducing balance, but still straightforward actually, really. So you should be fine. If you practice on it, I think you'll be fine. Trust me, you'll be fine.